everybody. So we are going live here, and Tuan is going to give us a thumbs up when he sees us on the screen. Keep refreshing. But meanwhile, welcome everybody, and welcome to a SimplyFI Live. Wow, we haven't done one of these for a while. But what we would like to do every so often is to. Am I getting the thumbs up from? Oh, what's going on?
Waiting, sorry.
Is it
Waiting,
finished?
yeah.
No, it's not finished. It should be. It should
Yes,
be.
it's
Should,
just gone. Yes,
yeah, we're on. Awesome. Okay, cool.
just started.
All right, good. So in 2021, you can't start one of these without going like, is this happening? Am I on mute? What's going on? Welcome everybody to SimplyFI Live, and my name's Steve, and I'm here with Elie and Tuan. We are SimplyFI board members, and we are super happy to be talking to you today. What we want to do is we want to come in about every month or so. We come in and do a live stream and answer your questions. Just talk about the basics of expat investing, and just to say hi to all of you. You know, we're so proud that we've got 17,500 members. It's just amazing. So we're really happy to be here with all you guys today. So welcome, Elie and Tuan. Do you want to quickly introduce yourselves?
Right, I'll start real quick. I'm Elie. For those who don't know me, or for the new joiners out there, I've been around in the group for maybe a couple of years or a bit more, and I've been on the board for about a year. And yeah, super happy to be here, and hopefully we can answer some of your questions here.
Awesome. And by the way, if you're watching, just drop us a little comment. Just say hi so that we can see that it's all working and you can hear us and everything like that. Because we had some tech difficulties, as is always the way. Oh, there we go. Awesome. Hi, Prasoon. Hi, Tristan. Can't hear that well. Okay. Yeah, that may turn and Elie, you might have to speak like really loudly and clearly for this to work. I'm going to whack up the volume as well because it's probably relying on my volume. Okay, cool. Awesome. So let's get started. Meanwhile, what you can do is to ask your questions. Sometimes it gets a little bit fast paced in the comment box. So you can go to HTTPS, you can go to mentif.com and you can type in the code 64011735 and you can upvote questions, and you can ask questions if they haven't been asked already, and we will go through that. Meanwhile, Tuan, hello. Do you want to introduce yourself?
Good evening, everyone. It's good to be back. I hope, yeah, I wonder if anyone missed us. It's been a couple of months, and I think we've had about 3,000 to 4,000 new members. So welcome to all the new members, and I'm glad you can join the group and join us. I'm part of the board team, and I've been with the group literally close to day one. So it's been five odd years. I'm based in Abu Dhabi, so one of the few people that's not in Dubai. And yeah, I guess always happy to chat with people on and off the internet about their finances and things like that. So,
Amazing, thank you, Tuan. So, one of my clients described Tuan as like a manual the other day, and but she hastily clarified that this didn't mean that he was boring. It just meant that he had like an encyclopedic knowledge of expat financial independence. And then we also have obviously Elie here, who wrote the Getting Started guide. So I'm super happy to have these two chaps with me today. Quick disclaimer, obviously, when we're answering people's questions, we are just sharing our experience and what we do ourselves. We are not giving you financial advice, so don't try to sue us because we're not telling you what to do. We are merely providing educational, entertaining experience, and hopefully you might learn something from it. But it's your own decision as to what you do with this. And obviously, if things do go pear-shaped, then we won't have any money either because we're doing exactly the same as you. So on that note, let's get started. We wanted to just have a quick little overview of expat investing and the things that you really need to think about. Now, I break this stuff into kind of like mindset and planning, saving and investing. So let's start with Elie. You know, like when it comes to like mindset and planning as an expat, what do you think the most important things are for a total newbie to the world of expat investing to think about?
Well, in my case, the first thing that comes to mind is basically to set an actual. Am I audible? Okay. So the most important thing is actually to set a target because many people start off without setting any target and they just kind of wing it. So that actually doesn't really work. So the most important thing is to set a target to understand what your FI or financial independence number is. And because if you don't have a target, then you obviously can't hit it. So that's the first thing that comes to mind in terms of planning for your investments, for your financial independence, or whatever the case might be. So that would be the first thing I would like to stress on. Plan, then implement. Just don't start off without having a plan in mind. I mean, a written plan in place.
I love it. Yeah, absolutely. I mean, it's just like losing weight, right? If you want to lose weight, you have to have a target. Otherwise, you're never going to lose anything and you're just going to eat that chocolate bar, right? So you need to do the same. You need to understand like where your finances are now and what your target is and then how you're going to get there. And if you take the time to plan that, especially if there's two of you, then plan it together. Please, please, please do plan it together. If it's just you, find a friend or find someone on SimplyFI who you can kind of partner up with as an accountability partner and do this stuff together. And Tuan, how would you go about setting this target?
Yeah, so that's a good question. I guess my point with all this is that the mindset is one of the biggest important thing. And the first point I recommend people doing is actually telling themselves that financial education, all this is actually quite easy. Because for most of the people's life, I've had everyone telling them, oh, it's too hard, it's too complicated, leave it to the professionals, let someone else manage your money and things like that, which is not a good mindset because no one cares about your money as much as you do. And in this part of the world, it is quite dangerous. There's lots of sharks around that are happy to manage your money for you and turn your money into their money very efficiently. And I guess the mindset of educating yourself about finance, it has huge ramifications for the rest of the life in every other aspect of life because money is so important. Because you've got life goals and plans, right? As we mentioned, your retirement, you might have a wedding, houses, and things like that. So when you have those big aims and you've got big financial goals, you can break them down and you can see how easy it is to reach those kind of financial milestones and things like that.
I love that idea. You know, like just if you, so many people think they're bad at money, right? You don't have to, if you believe you're bad at money, you will be bad at money, right? If you say to yourself, I am not good with money yet, or you say, like, I am good with money. Every morning you look in the mirror and say, you know what, I am good with money. You will start to become good with money and you will you'll read the Getting Started guide. And before you know it, you will be answering the questions on SimplyFI. You won't be asking them. It happens surprisingly quickly. And you just have to have that belief. So yeah, mindset is super important. Not getting trapped into a long-term savings plan is important. And knowing what your target is, the good old 4% rule. If you want to live on $40,000 a year, then you're probably going to need $1 million in stock and bond portfolio. What I always say is you need some cash, right? 6 months cash buffer. Please, please, please have your cash buffer. Then if you're as Tuan said, if you're saving up for a house or a wedding or a car or something like that, then you can start putting sinking funds towards that. But once you've got that cash, you don't need any more cash. There's no point in sitting on a big pile of cash doing nothing. It's literally not going to do anything. In fact, it's going to disappear with inflation. And so then especially because you're an expat. You're not going to have some fancy pants state pension or company pension waiting for you when you retire. You need to start building assets that are going to generate an income stream for you, whether that is property. I don't like property, but whether it is property or it is stocks and bonds or a business that you invest in or whatever, you need to start investing in assets that are going to generate income that will support you in retirement. So let's start thinking about that. Now, the saving part is almost the easy bit, right? I mean, you have to increase your income, you have to reduce your expenses, have to get out of debt, get out of expensive debt, and start saving more money so you can put that into your stock portfolio. Elie, any super tips here that you picked up? We're all human beings, right? We're not like super gurus. So like sometimes we don't always find this easy. Any super tips or incredible mistakes or anything like that you've made on the earning, spending, and debt and saving side of things?
Yeah, I would say my biggest mistake is for waiting long before starting investing. So that would be the killer mistake that I have ever made. So don't don't be scared. Just start. And again, I always like to take a page from Nike's book. Just do it. Just start. Start somewhere. Start, and then you can optimize. Because I can see lots of questions about how can I optimize my transfer costs, or how can I don't know, optimize my fees. I mean, that's all good, and I have absolutely nothing against that. But just start somewhere, and then you can always optimize.
Absolutely. I really like that. I mean, I've met people who like for 4 years they've been asking how to get started and they never got started investing. I mean, while the stock market's just gone up and up and up. So do get started. And I think once you see that momentum build up in your investing, you will have a reason to not spend so much money. And instead of the quick thrill of buying a fancy new phone or a new handbag or whatever it might be, you will have the thrill of dumping more money into the stock market every single month. And therefore you'll be motivated to reduce your spending. Turn any tips around debt or spending or anything like that?
Yeah, I'm like what you just said too. I started really slowly, and I just started with something basic and slowly improve over time. So the hardest part for most people, as Ellie mentioned, is just getting started. And a lot of people, when they start, especially if they're new to all this and new to budgeting, they might think, "Oh my goodness, I don't know how much to save, or I can't save much." Things like that. I tell people, just start small. It's like going to the gym for the first time. You're not going to lift 200 pounds on your first day at the gym, right? You start off with light weights and you build it slowly and build it over months and months. Uh, and yeah, use the support of the group to help you, encourage you. And before long, you know, you build up a really good habit of monthly savings, and the savings rate is increasing. And the next thing you know, you've got a wonderful portfolio that's growing by itself.
Awesome. I love it. Thank you so much. I like the analogy of the weightlifting, right? So yeah, you just get started and start small, and eventually you will build up. Like every 1% that you can increase your savings rate by, and every like $100 that you can put extra that you can put into the stock market every single month, it's going to add up and make a difference. I know we're getting some technical issues on the voice side. It may be related to my microphone and this like crazy tech setup that we've got streaming at the moment. So I'm going to try moving the microphone around. Let us know if you still can or can't hear Tuan and Elie when they speak going forward. Okay, so we've done the planning and mindset. We've done the saving. I think lots of our questions today will be about investing, so we don't have to spend too much time on that. But if you were to give your top tips on investing, Elie, what would you say?
Well, there's no single secret to that. So it's basically get your psychology right, get started, know your targets, and just stay the course. That's all I can say. And for those who are new around, please make sure you download and read the Getting Started guide. So we made sure in that guide to summarize all the basics, everything you need pretty much to get started and to, yeah, I mean, it will help you to get started and and basically carry on with your investing journey.
Yeah, absolutely. Absolutely. Tuan, what do you think?
Yeah, so my main one tip would be to keep it simple. As they say, simplicity is the ultimate sophistication. Often we find people tend to do too much too soon, uh, right from the start. And most people approach me asking the question, how do I improve? What can I add to my portfolio to improve it? Whereas I tell them, actually, you should be thinking of the opposite way. What can I remove from my portfolio to make it more simpler and more efficient and better? So, as I mentioned, all the experienced investors will tell you keep things very simple and easy, which is one of the fundamental reasons why we tend to recommend two funds portfolio. It's simple, it's easy, it's efficient, and it's effective.
Turn, you just took the words right out of my mouth, and I really love that. Like, simplicity is really beautiful when it comes to investing, and our brain is not geared up to reduce things and to aim for simplicity. We love adding complexity. We love adding extra things, extra funds. Like, oh, can I just improve that tiny amount? You can do that with your spending and saving, yes, but when it comes to your investing, literally a two fund portfolio is all you need. And I would say, don't be quiet about this, right? You're lucky that you've discovered SimplyFI, frankly. There are loads of people out there in the UAE and beyond who do not know how to do this, and they are at risk of getting snared into terrible products. So tell everybody you just need an international brokerage like international interactive brokers or Saxo Bank or Swissquote. That's all you need. Plus investing in ETFs, exchange traded funds, expat, total freedom, whatever you want to call them, ETFs. That is all you need. Like those two things, they are the secret sauce of expat investing. Tell your family, tell your friends, tell your colleagues. Right, let us answer some questions. So hopefully everybody has been upvoting and asking questions. I'm going to pop in the chat box here what the code is for the questions. Let us tackle the first question that we have tonight. This is a really good question, actually. How to calculate the percentage growth rate of your ETFs? Tun, it sounds like you want to go with that one.
Yeah, I'll start with that. There's a couple ways you can do that. If you're with a brokerage like Interactive Brokers, in your portfolio summary, they do statistics on your portfolio for you. Now, unfortunately, the default setting is what is known as time-weighted return (TWR), which just simply calculate the return from one point in time to another, and that's not very useful for the individual investor. It's more useful for the fund. However, the normal investor puts in every month or every so the return is going to be very different. Now, what that is called, it's called money weighted return (MWR) or the internal rate of return. What I'm going to do after this is I'm going to post a link to a nice article from Investopedia that explains about this. It also has spreadsheets, linked to free spreadsheets, how you can calculate that on your Excel spreadsheets. And you can do it to your heart's content, modify to your portfolio so you can calculate it to your own portfolio. But IB, and I'm not sure if the other brokers may have that as well. Just simply go to the settings and change it to money weighted return (MWR), and hopefully it will calculate your return depending on when you put the money in.
I mean, the other thing you can do is because getting obsessed with this growth rate is a bit dangerous, because like you need to measure this growth rate in decades, right? Like what it's doing over a year is just not really that relevant because you have to have a long time horizon for investing. So I would just go to the fact sheet of the fund and it will just show you like what the fund is doing. I wouldn't worry too much about your overall portfolio. You maybe like once every 5 years or once every decade, I would bother having a look at that. But otherwise, the results you're going to get are just like not really very indicative. Um, Thank you very much. Tuan and Elie, I think we're still getting some sound problems. If you can just speak really loudly and slowly and clearly, that would be awesome. And apologies for the sound. Let us zoom along to the next question. So the next question is for all of us who invest in VWCE in euros, is there I did say no question too technical or too basic. Is there any difference if we buy the quotes on Xetra, Milan, or GetX? IB uses the smart function every month. I buy a quote from a different exchange.
I'll take this one as well. Um, yeah, so the ETFs we buy is what's known as fungible, which means that it can be replaced by another of the same kind. So every ETF of each person that buys it, you get the same benefit as another one, and you can simply replace with each other. So what it means that it does not matter which exchange you buy it from; they are all exactly the same. Now, IB uses what's known as a smart system. It's actually quite it's very good in a sense that it will go to all the exchanges that your ETF is available and will pick the cheapest available at the time. So if it's on 3 or 4 exchanges, it quickly queries which is the lowest price for you, and it will pick that for you. In terms of anything else, there's no difference between whichever exchange you buy it from. It makes no difference at all. So it's like buying bread. You can buy bread from any of the supermarket. It does not
um,
Maybe
I, I, I,
another example
yeah.
would be if you're buying off Amazon, and if you're buying any product on Amazon, as you can see, or for those who have bought on Amazon, you can see that you have in some products have multiple vendors offering the same product. So usually the price is very close with all these vendors. And usually Amazon gives you the cheapest one of these. So that's exactly what IB is doing in that regard. So the short answer is it doesn't really matter over the long term. Yes, sometimes you might save a couple of cents here and there, but over the long term, that shouldn't really matter.
Yeah, exactly. And it's a pretty nifty service. I don't think it's that useful for people buying Irish domiciled ETFs in dollars because that would pretty much be on the London Stock Exchange. I mean, stop me if I'm wrong, but it is much more useful if you're buying funds in euros because there are all those different European stock exchanges. Awesome. Thanks, guys. That was nice and clear. Um, let's have a next interesting question. Um, Is SimplyFI a commercial group or a self-promoting group or a charity for the good cause of UAE expats? Well, let me be very clear. We are not in any way a commercial entity. We don't accept payment. We don't have any affiliates. I know some Facebook groups allow you to advertise and they pay the admins to advertise. We don't do any of that. I think the most we've ever done is like we hired some chairs once and then some people gave us some money to cover the chairs, like when we were doing a talk. I mean, that is as far as we go, right? So we're not even, it's not like we're a non-profit, like we're basically a non-revenue, right? Like, but I also want to stress like we are not a charity. We're not a charity, right? UAE is very strict on charities. We are a community. I mean, like these days, we're basically a website and a community on a Facebook group, and that's what we are. But that's all we need to be, right? Because we're spreading the word in that way. Occasionally, we do have in-person meetups, but they've kind of been disrupted by the pandemic. But that's it. We don't need to be anything else. We're not trying to sell books. We're not trying to sell. We're not trying to sell our guides. And those of us who are coaches, or I have a coaching business in financial independence. When I'm dealing with SimplyFI, I shut up about it. We have very, very strict policy of not promoting our own stuff. And that's why, that applies for financial advisors. It applies for insurers. It applies for any kind of financial services provider. They are not allowed to promote themselves on SimplyFI apart from on the lazy weekender thread once a week. That is why we have 17,000 members, because there is a trust issue in financial services in this part of the world for expats. And so, we want to create a safe space where people can trust what we say, because we have no motive other than just sharing our own experience and sharing what we think works. So that is that, guys. I don't know if you want to chip in briefly, otherwise we can motor on.
So just a quick point. So we are part of the US Bogleheads, which is a non-profit foundation which is based on financial education. That's all it is. So we provide education, and the members, we give our own time, donate our own time, and help the group. And things like and most of it comes from our own experience. I don't work in the finance field, so I definitely don't have anything to sell. I'm just a keen investor and keen on financial education.
Awesome. All right, thank you very much. So let's keep going. Our next question is thoughts on UAE national bonds. We get this question quite a lot. They seem to have capital protection as per a fatwa. What is that, and how does it compare to the SIPC? Elie, Tuan, any thoughts on that?
I'm sorry, not my area of specialty.
I mean, my thinking on national bonds is they are a savings product. They're not to be confused with bonds, as when we say stocks and bonds. They're different. It's more like the British English use of the word bond, which is like a premium bond or something, like a savings product. The protection is they're protected by the state of the UAE, right? So they are backed by the government. And I think that backing is pretty decent, right? The UAE has cash reserves, and so I think that backing is pretty strong. Fatwa is basically like a decree. So it's very different to the SIPC, which is the US coverage. It's the kind of insurance body that protects US brokers if they go bankrupt, and protect their clients as well. That's up to $500,000, but it's just very different, right? I mean, it's not a US government backing, whereas national bonds are UAE government backed. Having said that, the interest rates, you're not going to make more on national bonds than what you would make in the stock market. So as a place to park your cash, for a cash buffer, as long as you can get it out quickly, or a sinking fund because you're going to buy a house in the next 5 years, then probably like a good place to put it. But not as a place to put as an alternative for stocks and bonds, or as an alternative to your bond component if you are an Islamic investor. I don't think it would give you the downside protection that bonds or sukuk or gold give you. Awesome. All right, next question. 1 minute per question. Awesome. Let's do this. We've got a suitable ETF for me, but it has to be free from US taxes. All right. Nice, easy question, guys. Who wants to tackle this?
Well, before we tackle the question, it's important to know where you're from, your nationality, because that's important. For example, if you're a US citizen, then the choice of ETFs for you would be different. If you're a Canadian, then again, the choice of ETF would be different for you. For the others, I would say look for European ETFs, the ones that have UCITS in the name. So that would be more, more tax efficient for you. I'm not sure, Tuan, if for the Aussies there's any. I mean, I think are they better off buying from the?
Yeah, so if you're an Aussie, it's similar to Canadian too. It makes it a lot easier later on down the track if you're planning to retire and return to Australia to buy off the Australian Stock Exchange, which is in Australian dollars, rather than because if you have US ETFs, US currency ETFs, and you bring back to Australia, there's difficulties, and you have to go through. You have to calculate all these things, which is a bit of a mess. So, best thing to do is buy off the same stock exchange.
Yep, awesome. Yeah, I agree. Okay, cool. Next question. How inflation proof is a whole world ETF like VWRA considered to be? So VWRA is the Vanguard FTSE All World Index Fund. It's got 3,500 companies in there across 47 countries. How inflation proof is this? Personally, I would say that stocks are actually relatively inflation proof over the long term. Sudden shocks in inflation, sudden spikes in inflation can mess up stocks and bonds, to be honest. But when inflation pushes prices up and companies, especially if they're able to put their prices up and make more profit, obviously if the inflation is hitting their raw goods and materials and the workers and salaries and things like that, that's not so good. But if it enables them to put their price up, if the price of a cup of coffee just generally goes up, then their profits are going to be bigger numerically. Therefore, their profits per share are going to be bigger numerically. And so the share price will tend to go up. So shares are relatively inflation proof. I wouldn't be worried overly about that. And certainly just because, there's some nigglings about insurance at the moment, which may be just temporary as we come out of the pandemic. I wouldn't be like selling all my stocks or anything like that. That's market timing, because inflation and interest rates are notoriously very, very, very hard to predict. So don't even try. Guys, any thoughts on that?
Yeah, I'll just quickly add, of all the asset classes, stocks is in fact the best inflation proof you can get. Now, historically, the world has grown by about 8 to 10% a year, which is roughly 5 to 8% real gain over inflation over the long run. Without a doubt, stock has been the best bar none to combat inflation. That is why one of the main reasons why we invest in the first place.
Awesome. Elie, obviously feel free to jump in if you feel strongly about these things. Otherwise, we can keep motoring on. All right, cool. Next question. Why aren't the Vanguard Life Strategy ETFs a core recommendation for people retiring in the Eurozone? So Vanguard Life Strategy, if you live in the UK, it's almost a no-brainer. You just buy Vanguard Life Strategy. It's like a pre-packaged fund that has stocks and bonds in all in one. So you don't have to worry about rebalancing. You don't have to worry about buying two different things. You just buy, let's say, the 80% stocks, 20% bonds, or if you're about to retire, the 60% stocks, 40% bonds, and then that's it. They've just launched an ETF version. Otherwise, it's very difficult for expats to access these. So we typically have to buy a stock ETF and a bond ETF separately as an expat. But they've just released the Vanguard Life Strategy ETF in euros, but not in dollars, not in pounds, not in anything else. So why isn't it a core recommendation? Any thoughts, guys?
No, it's actually perfectly fine. I mean, if you ask me, it keeps things simple, as Tuan mentioned earlier. So instead of you buying two ETFs, and if euro is if you want to retire in the Eurozone, yeah, by all means, go for it.
Yeah, it's perfect. Definitely if you're retiring in the Eurozone, Eurozone as well. Because what Vanguard does with these products is that they do a lot of work in terms of the tax, local tax as well. So they will bias the bonds and equity slightly towards the home biases where they can achieve the most tax efficient way. They've done the homework already. So if you're from Europe now, you have slight tax advantage with these products as well.
I think I've got two caveats. I think they are a great product, and I think you can go for it if you're a Eurozone investor. My concern would be just to make sure that the allocation towards Eurozone stocks isn't excessively big compared to how the Eurozone stocks feature if you add up all the stock markets across the world. Right? I kind of believe that you shouldn't be like particularly biased to your home region. So I would just check about that. The second thing is like when you retire, it's quite nice to be able to choose when you take your money out whether you sell your stocks or you sell your bonds. If stocks are doing really well and bonds are down, you sell your stocks. If bonds are doing really well and stocks are way down, it's actually quite nice to be able to sell your bonds to generate that income for that quarter or that year or that month or whatever you need to live on in retirement. When you have an all-in-one fund like Life Strategy and you need the money, you're going to be selling some stocks and some bonds at the same time. So you're going to be selling some stocks when they are down during a crash. I don't love that, but that's like a little optimization tweak. Otherwise, yeah, I think they're cool. Next question. How does US taxation work for a capital investment in Irish domiciled ETFs that have surpassed the the $60,000 threshold? So yeah, when there is, if you invest in a US domiciled stock or a US domiciled ETF, so for tax and regulatory purposes, it's based in the US, then when you've got more than $60,000 in cash or US dollars or cash in US stocks or US domiciled funds, once you've gone over that 60K threshold and you die, you may be liable for 40% inheritance tax. Ugh. So you want to avoid that. You can have an Irish domiciled ETF instead, then there is no US inheritance tax. So that's an easy way. There will still be a withholding tax on dividends. You can expect like dividends of like 2% on a global stock fund. And the tax of that will be 15%, 15%, instead of 30% for a either a European domiciled ETF or a US domiciled ETF. So that's the tax situation. No inheritance tax whatsoever for Irish domiciled ETFs and 15% on the 2% of your dividends, your dividend income. So that's pretty small tax. And that's why Irish domiciled ETFs are fab. Folks, anything to add on that one? Cool. Okay. Next question. Oh, here's a corker. Right. This is why we do these calls, just to answer questions like this. So, the stock market can't climb. Where's my question gone? Wait a sec. What's happening? Hey. Here we go. The stock market climb can't continue and the bubble will inevitably burst. How do we prepare for this? Should we rebalance our portfolio in advance? Over to you guys.
That's an interesting one. Do you know how many times this question got asked in the past? And do you know how many times the stock market hits an all-time high? The question is, the answer to that would be every couple of months. So every couple of months, the stock market reaches an all-time high and people get this fear of heights. And it has been so for the last couple of centuries. So there you have it.
Agreed. Tuan?
Yeah, so what I want to mention is that, the stock market going up and down, it's a very natural thing. Right, boom and bust cycles is part of life. When do they occur? No one really knows. Now, the key thing is that we cannot control, as an individual, we cannot control the stock market or what the government do or what the industry reacts to it. All we can do is control our own personal situation. So from this perspective, it goes back to you want to be able to survive any down period so you can flourish when the good times comes again. So this comes back to the emergency fund. Make sure you always have an emergency fund to cover any short-term personal problems you might have, like a job loss or family being sick and unwell. All you need, when the stock market eventually does occur, all you simply have to do is to rebalance your portfolio according to your asset allocation. That's it. That asset allocation is your compass. It tells you exactly how much to buy and sell and when to do it. There is simply no guessing. The problem is that too many people speculate. And as there's a very famous saying that more money has been lost in anticipation of a market drop than the market drop affects you. So you're going to always lose more money if you start to speculate. So yeah, best advice is do not worry about the market. Have a basic plan and keep investing.
Yeah, I totally agree. I mean, just take your brain out of this. I mean, this person's already getting stressed about this bubble bursting. Like, not every increase in the stock market is a bubble, right? Because it may be that earnings increase and that supports the share price. So all the profits of these companies like gradually increase, and then they support the share price, and the share price carries on going up. I mean, if you look at 2011 to 2020, it pretty much went up all the way, right? The entire way, plus or minus a few little niggles here and then along the way, but like basically it went up. So like, how can you tell this is a bubble, right? Sure, 2001 that was a bubble, but how do you prepare for this? You have to prepare for this mentally. Like read around this sort of topic, like behavioral finance. Read Unshakable by Tony Robbins. Read Millionaire Expat, like any of these things that will help you not panic if there is a crash. Now, the other way to prepare for it is to really think about like what should your asset allocation be? Like, can you handle a 50% drop in the stock market? Because if you can't, then there's no way you should be 100% in stocks, right? Because you must not sell during a downturn. But you also should not be tweaking your asset allocation because you think that there's a crash around the corner, or because you think there's a boom around the corner, because you might be completely wrong. And so trying to actively manage your allocation in that way, it just does not work, right? You'll be wrong-footed every single time. You as the goalkeeper will jump left and the ball will go to the right every single time. So just don't do it. Think like, okay, I've got a reasonable appetite. I can handle 80% stocks, 20% bonds. I can look my other half in the eye and say, like, at least we prepared for this, right? If you are absolutely scared out of your wits, then just go 60-40, right? The retirement portfolio, 60% stocks, 40% bonds, and just stay there and make sure you can sleep at night. So that when the stock market does crash 50%, which it is capable of doing before it goes back up again, at least you don't panic sell. And at least your portfolio is less volatile because those bonds will support it, so that your portfolio, no way your portfolio will crash 50%. If you're 60% stocks, 40% bonds, it might crash 20 or 30% instead. So yeah, thank you guys. Another question: how does having multiple offshore bank accounts help? I have an account in Dubai and India. Would having another one, say in Standard Bank, the Isle of Man, help in any way?
I think it largely depends on your country of origin, on your nationality. I mean, in my case, I'm from Lebanon, and for those who haven't heard of it just yet, we have a very unstable banking system back home. So hence, in that particular case, it makes sense to use an offshore banking account. But for some other, I would say, stable countries, Well, it depends. You don't always have to have an account in the Isle of Man or in Switzerland or in some sort of different jurisdiction. But again, it never hurts. So again, it depends on your nationality and your country of origin, pretty much.
Yeah, I agree. I mean, you don't need to have like accounts everywhere. I just think you need some money in Dubai if you live in Dubai, maybe 25 to 50% of your cash buffer. And then the other 50 to 75%, yeah, as Elie says, if you don't trust your home country, then Isle of Man is great. If you trust your home country, then you can put it there. But like India, for example, there are lots of banks that are offering like crazy interest rates for even for dollar deposits. That's a sign that it's risky, right? I mean, just ask the Lebanese. Like they're offering like 10, 12% uh, for deposits, right?
They used to until the whole banking system crashed.
Exactly, right. Because it was risky, right? And so like some of these smaller banks in India, they could collapse and you lose all your money. So do be careful with that. Like choose something somewhere where your money is going to be safe, hopefully protected by the government. Um, okay, cool. Next question. Tun will like this question, or maybe not like this question.
I know exactly which one you're talking about.
Yeah, exactly. So I took out a savings plan, investing 1.5K per month. Charges are about 2% per year on the amount paid, plus blah, 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 a whole bunch of other charges, plus lots of hidden charges, by the way, I'm sure. Should I continue or cancel? I have put $9,000 in already, and I will lose all of it if I cancel. Please help.
All right. Oh, my favorite topic of all. Yeah, I'll take it easy. Yeah, hopefully this person, whoever you are, do send me a quick PM, and I'll send you a paper on these products, which will explain to you in more detail exactly what they are and what options are available to you, so you can make the most informed choice moving ahead. Um, Having said that, yeah, these savings plans. Very well-known expat strat. Now, the Evo 10 is, I'm assuming it's a 10-year one, and the Evolution 10. This one is not as bad as a couple of the other insurance similar savings plan, but unfortunately, they all in the same vein. Anything insurance-related product is a bad investment. There's no short way about it. Now, for people who are new to this and haven't heard me rant, basically these insurance plans are designed to make the promoters and the providers money, not you. One thing that people don't realize is that there's actually no investment being taken place at all. Now, when you for example, every dollar that you give the insurance, hand over the insurance company, they simply hold it and take money from it through charges. So, for example, you might hand over $1,000 in money. They will pay commission out. They will take their fees out, and this and that. So over time, the amount of money that gets returned to you becomes less and less and less. Insurance, it's insurance based. There is not investment at all. You are statistically guaranteed to receive less money than you put in. It's a fact for all insurance. Otherwise, they will go out of business. Now, the problem that most people have is that they've already committed so much capital and they stand to lose $9,000 already. Unfortunately, this is used by the insurance company to hook you into continuing. So if you read the fine print, you'll find that that will make a lot more money from you. In fact, they will, yeah, there's lots of hidden charges that are much higher. Now, the problem with all these plans, and our recommendation has always been the same, is to get out of these plans as soon as possible. The main reason is that the direct cost is very small compared to the opportunity cost. In fact, the paper that you'll get sent will show you that the opportunity cost of staying in these plans is 10 to 20 times more expensive than what it costs of incurring of leaving. So if it costs you $9,000 to leave, it will cost you 90 to 100 to up to $200,000 in opportunity cost if you remain. So there's no way about it. Our recommendation has always been the same and consistently get out as soon as possible. Treat it as your financial education. The cost of your university fees of learning the hard lesson of never letting someone else manage your money in this part of the world.
And to add one more thing here, the $9,000 or so that you lose if you pull, if you stop the plan. So guess what? The ugly truth is this is money that you have already lost. So the money is gone. So what you see in your account is just virtual. It's not real.
It's fake. It's all fake.
And yeah, Karen.
Yeah, and unfortunately, they tell you that in the fine print too. There's no investment ever taken place. There's nothing going on. They just pretend.
And if you're feeling cross about this, then go and tell everyone you know not to buy one of these plans. And that's why SimplyFI exists, really, is to protect people from these plans and to show you another way where you can control your own money. It's a lot cheaper, and you will make that 9K back so fast. Don't worry. And there'll be a weight lifted off your shoulders. This is why, you can't trust most of the any of the commission-driven advisors out there, because they want their commission, right? Sorry, but you just can't trust them. Okay, let's move on. At retirement, should we begin to sell stocks or switch to distributing stocks and just spend the dividends and reinvest any remaining above 4%? Well, when you retire, obviously you're not going to sell everything immediately, but yeah, it's probably worth moving from accumulating stocks where the dividends are an accumulating fund where the dividends are reinvested to a distributing fund where it pays those dividends out in cash, because you need cash, right? You need $40,000 or whatever a year. So at least half of that, if you're using the 4% rule, then maybe 2% can come from dividends. So that's pretty useful. So yeah, definitely do that. So you can switch to a distributing ETF. And yeah, I wouldn't just spend the dividends though, because it's unlikely to cover your needs and you're probably being too conservative. Dividends are generally about 2% of your portfolio, right? So if you have a portfolio of $1 million, you're going to be getting $20,000, right? That's 2% in income. That 2% rule is super conservative. It's probably not going to cover your living costs enough. So you're going to have 20,000 that's going to come from dividends, and then 20,000 that's going to come from selling stocks or bonds, right? And you're going to sell whichever one's doing better at the moment. If stocks are booming, you sell stocks. If bonds are booming and stocks are down, you sell bonds. And what that does is it helps you to move back to your target allocation, which is probably something like 60-40 in the early years of your retirement. So that's what I would say. Folks, any questions? We're kind of having to move into, as we get into the last 7 minutes, we're going to have to move into kind of quick fire mode. We've got some nice questions coming up.
Cool.
Awesome. Okay. Please compare Sawa and Interactive Brokers, pros and cons. Well, let's change that a little bit. Why don't we compare robo-advisors, because there is Sawa, there's Stashaway, etc. And there's Interactive Brokers, there's Saxo Bank, etc., etc. So, folks, why don't we compare robo-advisors versus brokerage platforms? Let's go.
Well, yeah, very quick. In short, the robo-advisor is a complete hands-off investing method, if you will. Now that will cost you a tiny bit for the robo-advisor to manage your portfolio on your behalf. However, interactive brokers Swiss Quote slash or any other broker for that matter. So you have to do it yourself. So it's a DIY or do it yourself approach. So it's cheaper, but then you have to do the work yourself. So are you a hands-on or a hands-off person?
And when you're getting started, there's nothing wrong with start. If you don't have the confidence to do it yourself, then start with a robo advisor. And then if you're like, actually, I don't want to pay 0.85% now because I feel like I know what I'm doing. I want total control of my portfolio. Then you can like migrate to doing it yourself. But yeah, look, the robo advisors are definitely the good guys, right? If we look at the kind of whole of financial services in the Middle East, robo advisors are definitely the good guys. They are pretty cost effective. Not quite as cost effective as doing it yourself, but some people just don't want to do it yourself, and that's fine. So they both have a place in here. Awesome. Thank you very much. Next question. Maybe this is one for Tuan. Considering present inflation scenario, should IGLA, which is the iShares global government bond ETF, so that's G7 governments, should that be replaced by IGIL, which invests in inflation-linked bonds? If inflation goes up, the bond value goes up. Should we also include gold in the portfolio, IGLN? If you want to know what we're talking about here, I put the question in the comments so you can see it. So, Tuan, if we're worried about inflation, should we be moving our government bonds out and replacing them with inflation linked bonds and gold?
All right. Yeah, a couple of points. Firstly, gold. Gold is always an interesting component of a portfolio. It has a variety of uses, and the academic research has it mixed when it comes to inflation and protection. So in a lot of the time, it's a good hedge against inflation, but sometimes it fails as well. So it's not a foolproof way to protect yourself when it comes to inflation. Now, the question regarding IGLA versus IGIL. Now, I've always considered inflation-linked bonds more of a niche or / specialty product compared to the generic IGLA, which is generic government bonds paying a coupon. Now, the main the inflation bonds are extremely effective when it comes to protecting against inflation, hence its name. However, my main concern with the question and where people is going is that they are speculating, right? And when you speculate, it causes problems. Now, the thing is that we are investing over a long period of time, 30, 40, 50, maybe 60 years, depending on how young you are. Now, inflation might be for a couple of years and it might increase, it might decrease as such. If we're going to switch backwards and forwards, we're going to cause ourselves a lot of problems, market timing, and it's going to be more problems than it's worth. In my opinion, most people are best off with sticking with the generic bonds unless you have very specific circumstances that requires inflation bonds.
Also,
That's a short answer.
yeah, and also, I mean, we're talking about investing in bond funds rather than bonds here. So while an individual bond may be extremely sensitive to inflation, it might be certainly sudden increases in inflation, might be extremely sensitive to interest rates. A bond fund is going to be less sensitive because you have multiple bonds in there. So yeah, there may be a spike in inflation in the next few months or next year, and that could be a bit rough for bonds, right? But that doesn't mean that it's going to be rough over the medium or long term. And it may be as we start to recover from the pandemic that inflation just kind of like gradually kind of fades away. And so I think to like suddenly go, oh, inflation, everyone's writing about inflation, so let's like dump all our bonds, go into inflation linkers, go into gold. Well, gold doesn't always track inflation, doesn't always hedge against inflation that closely. So that may not help. Your inflation linkers, well, what if inflation doesn't materialize? And then, there's a big crash. Well, then your inflation linkers won't help you, but your bond funds would have done. So it takes us back to the whole goalkeeper penalty thing. You jump left trying to be clever, and the ball goes to the right, and then you end up feeling stupid, and you would have been better off if you hadn't done anything. So if you really cannot sleep at night and you are retired, so this stuff is important, then yeah, sure, maybe you can have 10% of your portfolio in gold, and maybe you can have like 20% of your bond allocation in linkers if it helps you sleep at night. It may not improve the performance, but at the end of the day, not stressing about these things and not jumping around depending on what the bogeyman of the month is, is going to be a much better thing to do. Awesome, folks. I've really enjoyed it today. We have come to our last question. What is the group's recommendation on UAE real estate investment through platforms like Smart Crowd, i.e., like crowdfunding of real estate? Where I don't want to talk about Smart Crowd in particular, but the sort of thing that companies like this do is they allow you to put like 1,000 dirhams or $1,000 into a property, and then lots of people own that property. So rather than you having to save up lots of money to buy one property, you can put lots of small chunks and buy many, many small chunks of multiple properties. What do you think of this, folks?
That's an interesting question. Well, it's not really my cup of tea, but that's just me. So I'm not gonna comment on this.
Turn anything?
Yeah, I've always been a mixed feeling about these type of platform. In the US, we've had the data have come in recent years, and it shows that these kind of platforms aren't too great as a whole, mainly due to the fees are high, and there's other problems like liquidity and other problems as well. And in fact, a couple of the big ones in the US, not necessarily real estate, but just the funding type, similar type, have to shut down, and people had the money stuck for years and can't take it out, and there's other multiple problems as well. Now, in regards to Smart Crowd, that might be a good platform as such, but my personal opinion is that I'm not a big real estate person either. And if I was to go into real estate, I would prefer probably the REIT route, which is the real estate investment trust, which you can buy as an ETF. It's faster, easier, and cheaper. So unless you have specific wanting something to do with UAE in particular, I would prefer to keep things like a global REIT instead, which allows you better diversification, cheaper, faster, and more efficient.
Yeah, I agree. And again, we've got nothing against any specific platforms, but these platforms are untested. Let's take a number of things, right? So firstly, Middle Eastern real estate values are incredibly volatile, right? It's not just the UAE, the whole region. In fact, any developing country's real estate market is volatile. So unless you're going to live in the country for 15 years or so, you've got to be very, very careful about investing in the real estate market. That's the first thing. Second thing is that these platforms and the structures have not really been tested in the courts, right? And so if someone sues someone else and it shows that the structure does not stand up in court, then it may be that you can lose your investment. Or if the platform goes bankrupt, like how do you find all the other people who own this property? It can be incredibly difficult. Another thing is if you want to get your money back, sometimes they have secondary markets where if that secondary market isn't very big, it will be really difficult to sell this stuff. I know some companies that are doing this in the UK, and they have really, really, really been struggling, right? And that's in the UK, which is a well reputed, very well legally, well structured market. And so here we're talking about, somewhere in the Middle East. I think, just like peer-to-peer lending, I think it sounds interesting, but I think it's risky AF. I'm afraid. So I would be very careful there. Okay, cool. So, folks, have we lost the video? Maybe that's a good time to stop. What's going on? Okay, well, the world is telling us then that